Welcome to Markets Now. I'm Michelle Rook, along with John Wenzel with StoneX Group. He is an energy expert in that field. And we want to talk about crude oil, first of all, John, because we're seeing price levels now at a level we haven't seen for many, many months. What, the end of 2021?
Correct. No doubt the oil markets are trading in sympathy with the equity markets and especially the banking problems. But really underneath that too, there's something else going on. We've seen an increase in global oil production versus global oil demand. There's a little bit of a surplus right now in the global oil markets. We've seen stock building globally, of about 1 million barrels per day. And we expect that to continue to happen until the third and fourth quarter. So that's also an issue, even without some of the overhang of the financial markets.
And so what do you think that means for crude oil longer term? Are we going to continue to see, we're mid 60s right now. Are we going to continue to slide or not?
I think the $60 price level seems to me a little bit troublesome because we've seen the oil producers slowly, ratcheting back rig counts. It's not been, enough to worry too much. But, part of the calculus this year to keep the oil markets balanced would be to see U.S. oil production be up anywhere from 3/4 to 1 million barrels per day. And, most recent industry folks are saying that's we're not going to reach those levels. But again, with all the calamity in the financial markets and the reality that there's oil stocks are building, what we're seeing is people backing off from, pricing what they believe the futures market will be or what's to come. It used to be, when we see that, we think in the fall that global oil demand is going to surge, you might have seen oil prices rally based on that. We saw that in January. Right now, we're in this situation, people want to, it's like the Missouri show me state, right? They want to see global oil stocks tightening before people start essentially betting on the price. Because unfortunately, that's what happens in the financial markets. There's financial factors that come in and bid up the price.
So what is it going to mean for consumers at the pump here this summer?
Well, for right now, it actually looks quite favorable. U.S. gasoline production is high, and prices are continue to be soft. Underneath it, when you look at the dynamics for refiners, it's still quite profitable, so they're running full steam. Right now, we're getting a lot of refinery maintenance, but that'll clear up, and we should see good stock levels into the summer. One thing I would mention is I'll go out on a limb and say I do not think we'll run into a situation where we have diesel, shortage where you saw in the news last fall. We've seen in the U.S. ExxonMobil put on 250,000 barrels per day of new capacity, primarily diesel, in its Beaumont facility. And globally, there's several other refinery projects that have come online for quite a bit of capacity. So I think that's favorable, and we should see prices stay a little bit, more in line and not be so volatile this year.
Yeah. So talk about diesel prices, record prices in 2022. How much have we fallen from the record prices on diesel fuel, and how much farther do you think we'll fall, or will we?
So in general, I think the banking crisis has given us a low spot in the oil markets. I don't think $60 is sustainable, but I could be wrong. But I think diesel prices are low like that too. The thing is it's my thought is even if we get back into $70 crude or low 80s, right now that means $2. Like if I was to say highway diesel prices of, from $3 to $3.30, maybe they go up to $3.50 to $4. But the run of last year is going to be a little tough to do because, we had this ensuing panic with Russian invading Ukraine, and there was several camps that thought that would be very disruptive to global oil balances. It hasn't been. Russia's been able to keep their production high. They've discounted oil a bit. one of the biggest global bottlenecks last fall was just the lack of refinery capacity, and that's very much been solved. There's 3 million barrels per day of new uh, oil refining capacity globally, and that's substantial. So that's when you think global oil demand is supposed to increase by 2 million barrels per day this year. We've at refinery capacity has outbuilt that, so it's coming online. It'll be there, and we expect prices to be a little less volatile because of that.
So do you think that farmers should be getting their spring fuel needs lined up, or even look farther down the road than that and getting maybe even fall needs lined up, or what?
Well, to the extent that they haven't already pre-purchased some fuel, I know sometimes we had some folks, last year we looked at prices and thought they were well this year because it was lower. But right now, I think, while the banking crisis kind of gets sorted out and we probably, folks would, if they like these prices and are advantageous for the fall, I would say go ahead and take a shot at some of these. But we also think patience in the oil market will pay some dividends. There's no need to rush out, today and buy some until some of the banking calamity gets ironed out. I think it will be, but we'll have to defer to what the Fed's going to do and some of these other things to see if those problems get resolved.
Yeah. And meanwhile, we're keeping a little bit of an eye on China with them reopening the economy up after COVID here. Looks like they're going to have demands down the road. And you have to wonder if maybe that's why President Xi is meeting with President Putin. Are they looking for some crude oil, maybe deals to be done there, or what?
Well, they've definitely been taking all of Russia's extra crude oil, and I kind of alluded to the fact that Russia hasn't had a problem finding buyers for its oil, and a lot of that oil, instead of going to Europe like it used to, we see it getting moved to the Med and put on super tankers and then shipped back down to India and Asia. And the irony of it is that even though Europe is boycotting Russian crude, what's happened is the crude oil has gone to India and China and other Asian countries. It's getting refined and shipped right back to Europe. So there hasn't been a bottleneck in the supply chain like everybody thought last year. And when you look at what happened to prices, they ballooned up and created almost a feeding frenzy where people stocked up last year, thinking that there's going to be shortages. Well, and actually now it's created surpluses this year because people's tanks are full in some places. And as production goes up, we see that demand ebb back. So, but I think that's a little short-lived. If we get global oil demand higher in the fall, there could be a race back to the top.
Great. All right. Any other marketing advice that you want to share with us before I let you go?
Well, one thing that we've talked about in the past is natural gas prices. They affect fertilizer and other things. And we really have a lot of natural gas production in the U.S. We're kind of blessed, but that also means that, as we go into the fall, I think, some of that there is potential for more rationalization there. We see nearby futures on that gas in the $2.30 range, while fall and winter is still $3.70 and close to $4. My speculation would be that as we get closer, as we go through summer, that time curve or that price difference between the winter and nearby will continue to be under pressure. So patience on fertilizer and those kind of things will be helpful, I think, in that market.
Yeah, that nat gas market has been in free fall. I think got below $2 at one point before bouncing. So it's been really a wicked pullback here. All right. Thanks, John. Thanks for joining us, John Wenzel with StoneX, and that's Markets Now.